You're thinking about delaying or postponing or stopping your property investment decision because of interest rates rising, because of inflation rising, right? That's what you're thinking. That could be the biggest mistake that you make this year. In this video, we'll go through the last 50 years of inflation, interest rates, and property prices city by city so you can make a data-informed decision of your investment decisions, not just base it on the media. All right, let's get into it. If you're interested, carry on watching. My name's PK and I help people build passive income through property investing using data without needing a $15,000 buyer's agent every single time. And in this channel, we talk about financial happiness, we talk about the economy, and we talk about property investing. Give it a subscribe, give it a thumbs up. You're going to get a really ton of value from this video. I'm really excited to bring you this one. So you can see here on the screen, let me explain this to you. So these lines up here, stay with me, and I know not everyone's a data nerd like me, but stick with me here. These lines are capital city house price performance. It's based on this left axis, which is basically property prices. And then you've got this right axis, which is interest and inflation rates. Both are percentages. This red line down here is the cash rate, and this dotted black line is the inflation rate. Okay, so there's 3 or 4 key takeaways or insights that is going to inform your decision to invest or not invest right now. Let me take you through those 4 inferences. The first inference is that not all capital city markets move in the same direction. So you can see here, between the 1990s and 2005, Sydney house prices in the green, they went up a lot, okay, and others didn't. So this one right here, I think it's Darwin, it was flat. Same with this one. I think that one's Perth, it was flat. So not everything moves in the same direction. That's the first thing. So you might be thinking, look, the housing market's going to crash right now. There is no one housing market. There are different cities. There's always opportunities to make money. That's the first inference. The second inference is that global financial crises or recessions, they cause the housing market to crash. So in these gray bars, these are the financial or global crises. So you've got the 1974 recession, and you can see that house prices of Sydney definitely came down, but then you've got other places like Hobart that went up, like Adelaide that went up, that Perth that went up. Same in the 1977 recession, Sydney went up, and other places like Melbourne came down. Same in this recession, same in this recession, same in this recession. In fact, in the global financial crisis, you can see almost all markets throughout the global financial crisis actually performed relatively well. And obviously we know what's happened in COVID. So inference number 2, people who say that recessions cause property market crashes are incorrect. Okay, inference number 3. Okay, let's try to understand the relationship between inflation and house prices. So inflation is this dotted black line. So back here in the 70s, you know, we had the oil shock and things like that. Inflation went through the roof. Okay, inflation actually went up to about 15%, as you can see here on the right-hand side axis. And so you would say, oh, inflation, you know, it's a really bad thing. Economy is doing very poorly. Let's see how the housing market did. So Sydney definitely came down. Melbourne was pretty flat. Then you had places like Perth and Adelaide and others, Brisbane, that did quite well. They went up. Okay, and then let's have another instance where inflation went up here. I think it's just around this region over here in the mid 90s, I think that is, or mid 80s. Inflation went up from about 5% to 10%. This is way above the inflation rates that we're experiencing now, by the way. And in that period, you can see Melbourne, this blue line, went up big time. Brisbane came down, Sydney was flat, and then other areas like Hobart went up. So once again, it didn't just crash the housing market. In fact, some areas grew double digits in those years. And then you've got inflation here. From the kind of 1992 period to 1995, steady inflation, which is kind of what we're going to experience. So let's see what happened there. So you can see here that Sydney was pretty much flat. Darwin was pretty much flat. Melbourne came down a little bit. and the others were pretty much flat or slightly down. So this inflationary period was pretty much flat for housing markets, okay? And then you've got this inflationary period leading up to year 2000 or the turn of the century. And in that inflation period, which is basically similar to the last one, you've got Melbourne house prices, almost doubling, I would say. Sydney doing incredibly well, in a huge boom market there. Adelaide doing incredibly well. I think Darwin doing incredibly well. Sorry, not Darwin. I think that might be Perth. And then you've got others that were pretty flat down here, like Hobart. So, you can start to see that just because there's inflation, that doesn't mean that automatically house prices come down across the board. Or it doesn't mean that automatically house prices boom across the board. There's so much more in the demand to supply equation that dictates house price growth than just inflation. And you're thinking, that's inference number 3, by the way. Inference number 4 is you're thinking, well, that's cool, PK, but let's get down to brass tacks, interest rates, the actual cost of borrowing. How does that impact things? All right, so the cost of borrowing or the cash rate is this red line. So you can see that through this period from the 70s all the way through to the early 90s, we've got interest rates back up all the way up to 18%. That's a huge interest rate. We're over here at the moment, almost nothing. And so naturally the conclusion would have been that, it's cost, incredibly more money to hold a property, hold a mortgage, pay off a mortgage in the mid 90s than it did in the 70s. Surely house prices in this monetary tightening period, house prices would have fallen, right? Well, that's not necessarily the case. You can see that Sydney started off at under 250 and at the end of this period ended up much higher than 250. And basically the rest of the markets were pretty flat, as you can see. Okay, so this is an unprecedented, it's not unprecedented, it obviously happened, but our interest rates aren't going up that much anytime soon or ever, I would say. And that didn't cause house prices to fall. Okay, the second thing is then you had some choppy interest rates going down and up and down and up. And despite that, Sydney continued to do well. You can see Melbourne prices went from about 200 up beyond 300, and other capital cities did really well as well. And then you've got interest rates that fell all the way. This red line fell from about 18% all the way to 5%, the official cash rate. And so the natural conclusion would be that, well, obviously house prices will boom. And they did in some areas. For example, this line, I think it's Hobart, went up. But you could see Melbourne actually came down. House prices came down. Sydney was pretty flat. You can see Brisbane did pretty well. So it's a mixed bag, okay? And then throughout this period, from about 1995 to about 2010 or just before 2010, interest rates were pretty flat, okay? Pretty much the same for a long time. And housing markets had this huge increase, huge run. Basically, every housing market went up more than doubling in that sort of, call it 20-year time period or 15-year time period. And then obviously interest rates have marginally crept down. And just because they've crept down, you can see not every housing market has followed interest rates perfectly. You can see here, Hobart has been pretty flat, even though interest rates were coming down. Same with Brisbane was pretty flat, even though interest rates were coming down. Same with Adelaide was pretty flat in the last decade, even though interest rates were coming down. Sydney went up, Melbourne went up, and actually Darwin came down, as did Perth. So once again, interest rates were expansionary in the monetary policy, but only really Melbourne and Sydney performed. Okay, so this is inference number 4. Interest rates don't have a direct correlation with housing prices over the long term. Just replay that, rewind that, listen to it again, because it's the exact opposite of what other people are telling you. Look, I'm not trying to say that you should just put a blindfold on and put all your money in housing right now. That is not what I'm trying to get at. I'm just trying to educate you so you can make more informed decisions. The media plays to the lowest common denominator, as do politicians, in debates. They try to convince the most uneducated. okay? Don't be the most uneducated, because those are the people who don't get ahead in life. Try to be educated, infuse your intellect with some real empowerment, and that way you can actually get ahead. Okay, so that was the fourth inference. And then I know the fifth inference, what you're saying is, PK, I see what you're saying. I kind of vibe with it. Thank you very much. But you, PK, have forgotten the fact that debt levels are at record levels right now. Okay, PK, you've completely overseen that. You've completely overlooked that. And you've also forgotten, PK, that wages aren't really increasing. So how can house prices go up anymore if wages haven't increased? Okay, things are just becoming more and more and more unaffordable. Okay, this is why it's different this time. That's what you'll say to me, right? Let me address that. Now, I don't have it on this chart specifically, but what I will say is back here, back here, back here, back here, back here, debt in Australia has always trended upwards. Household debt, business debt, government debt, generally speaking, over the long term, it's always trended up. So yes, we are at record debt levels, but we were also 5 years ago. And before that, we were also as well. And before that, we were as well. And before that, we were as well. So we've always been at record debt levels. That's how capitalism works. Expansionary monetary policy, or even if it's not expanding, fiscal policy since the 1970s, fiat currency, more and more money supplied, that just means more and more debt. Okay? And so we've always been at record debt levels, yet house prices have continued to go up. And so what about wage growth? You're saying, well, okay, debt, I sort of understand. But what about wages? Wages haven't been increasing. So how can house prices be continuing to increase? Well, back here, wages were increasing a lot, all the way to about year 1995, maybe year 2000. Wages were increasing a lot, and that really stemmed, or you could say, hypothesized, that house prices rose because of that. All of a sudden, the female workforce entered into the market, all that sort of thing. But what people don't understand is wage growth in Australia in real terms has not really been increasing for the last 15 to 20 years significantly. Yet, since 2000, house prices have more than doubled in basically every single capital city and regional center, for that matter. So there is not a direct relationship between wage growth and house prices, and that's completely unsustainable, you'll tell me, right? However, my theory, and tell me what you think of my theory is that house prices don't accommodate, unlike politicians, for the lowest common denominator. Housing markets aren't driven by the average person. As the economy, as the country expands, grows, population increases, what you start to realize is inequality, the haves and the have-nots. That's just capitalism. Don't blame me. I'm just trying to tell you what it is. Capitalism means that as if there's enough people in the top 1%, top 4%, top 5%, top 20%, even top 50%, there's enough wealth to create enough demand for housing to go up, even with wages on average not going up. Remember, the wealthy get wealthier, okay, and the average stay average or get poorer in purchasing power terms or relative terms. So you've got more and more wealth on one side of the equation, and that wealth is concentrated, it's saturated, and that is what creates demand for housing. So even in an environment where average wages don't go up, like they haven't really in the last 10 to 15 years, house prices have more than doubled. Don't make the mistake of thinking that house prices are dictated by the average populace. It's not. Fortunately or unfortunately, I won't make that social decision right here, but that's the reality. And so debt levels don't have a direct correlation. And in fact, right now we have record saving levels as well. So debt is high, savings is high, so net debt is actually very low, and wages, whatever happens to wages, it doesn't really matter. There's enough wealthy people, there's enough money on the sidelines, not just in the top 1% of wealth, but in the top 20% of people who are wealthy in this country to demand enough housing. That's the thing. And the last thing I wanted to take you through, and the sixth inference that I want you to understand, is this right here. This is from the latest budget, the federal budget domestic economy detailed forecast for different years. What you see right here is net overseas migration is likely to bring 40,000 new people this year, ending June 2022 in the financial year, 180,000 people next financial year, and then it just hockey sticks up, 213, up, up, up. Where are all these people going to go? This is going to create extra rental demand, extra pressure on the housing market with more and more demand. We know that buildings aren't getting out of the ground. It's too difficult, too costly to build. Demand continues to exceed supply. Another pressure point which will rise property prices in some areas across Australia. To wrap up this video, I've talked about 6 inferences. Go back and listen to it again, watch it again if you didn't quite get anything. But the point is, there's always markets within markets. Back to our first inference. I wouldn't say, just buy in Sydney, Melbourne willy-nilly right now, but there is so much money to be made in the Australian property market, markets within markets. There are still areas that are that are affordable, believe it or not, despite what I've just said about, debt and wage growth and everything like that. There's so much money to be made. I've just proven to you how everything that you've heard from the media and from most pundits, experts, and self-proclaimed gurus, not that I'm one, is completely garbage. Go with the data, guys, and really understand that. I'll leave links below to my podcast and a 15,000 member Facebook group where people are actually, marinating their intelligence in something that's real, something that will actually get them ahead, something that will actually give them passive income. Hit the subscribe button, turn the notification bell on, give it a thumbs up, give it a like. My name's PK. I'm very grateful for you to be watching this video with me. Thank you so much, guys. Bye.